Hey everyone, we are going to tackle a huge question today. How in the world do you actually build wealth in 2026? We're going to cut through all the noise and give you a simple but really powerful blueprint that's built on principles that just work. So let's dive right in.
So how do you actually do it? It can feel like you're drowning in options, right? You've got stocks, crypto, real estate. Where do you even begin? Well, the good news is there is a clear path forward.
And it all boils down to one single, powerful idea. This is the engine behind pretty much all long-term wealth. And once you really get this, I promise, the rest of the strategy just clicks into place.
And that big idea, we call it the snowball effect. Imagine you're at the top of a big, snowy hill with a tiny little snowball. You give it a push. At first, it barely grows. But as it keeps rolling, it picks up more snow, getting bigger and bigger and faster. Your money can work in the exact same way.
The engine powering this whole thing, it's something called compound interest. It's not just about earning interest on your original money. The real magic is that you start earning interest on your interest. Your snowball gets bigger, so the next bit of growth is even larger. It's this beautiful, accelerating cycle.
And this is where it gets wild. Just look at these numbers. See how a small tweak in your annual return has a massive impact down the road? The difference between getting a 7.2% return and a 12% return isn't just a little bigger, it's almost 6 times bigger over 40 years. This shows you that time is your greatest superpower when it comes to investing.
Okay, let's make this real. Meet Sarah and Jake. They both invest the same amount, just $200 a month. The only difference? Sarah starts 10 years earlier. That single decade of extra compounding means she ends up with more than double what Jake has. The lesson here is crystal clear. Start now. Even if it's small, just start.
All right, so you get the magic of compounding. Awesome. But where's the first place you should put your money? Well, before you start chasing those big returns, you absolutely need a solid foundation. And that brings us to what we call safe havens.
We're talking about a high-yield savings account, or HYSA for short. Now, this isn't an investment, it's just a smarter bank account. But it pays way more interest than a regular old savings account, it's government insured, and you can get your money whenever you need it. It's the perfect spot for an emergency fund or for saving for a big purchase.
Just look at the difference. The national average rate for a savings account is a tiny 0.61%. But HYSAs right now, they're offering over 4%. Think about it. On 10 grand, that's the difference between earning $61 a year and earning over $400 for doing nothing. It's the easiest first step to make your cash work for you.
Okay, with that safe foundation built, now we can start talking about building the skyscraper on top of it. It's time to build the real engine for long-term growth, investing in the stock market. And when you do, there are really 2 big philosophies to understand.
And really, it all comes down to one question. Are you trying to beat the market, or do you just want to own the market? Active investing is all about picking individual winners and trying to get a better return. Passive investing is about buying a tiny slice of everything and just matching the market's return.
So let's break that down a bit. Active funds have a manager who's paid to pick stocks, which means you're going to pay higher fees and you're betting on that manager's skill. Passive funds, on the other hand, just automatically track an index like the S&P 500, so the fees are way lower and your risk is simply the risk of the entire market.
But here's the thing. It's not an either-or decision. You don't have to pick just one. In fact, a really popular strategy actually combines the best of both. It's called the core satellite approach. And here's how it works. The big core of your portfolio, say 80% of it, is in those cheap, stable, passive index funds. That's your foundation. Then you use the smaller satellite portion for your more active bets, maybe some individual stocks or sectors that you really believe have a chance to outperform.
All right, let's shift gears. We've talked stocks. Now let's talk about another huge pillar of wealth, real estate. And just like with stocks, there are 2 main ways to approach it. One that's pretty passive and one that's very active. You can invest in REITs, which are basically like a mutual fund but for real estate. Or you can go out and buy a rental property yourself. REITs are totally passive. You buy and sell them just like stocks. But owning a rental, that's an active, hands-on business. It really comes down to one question. Do you want to be an investor or do you want to be a landlord?
Okay, now we're climbing to the very top of the pyramid. This is the high-risk, high-reward zone. And I have to say, this is advanced territory. It's definitely not for everyone.
Up here, you've got things like alternative assets, like cryptocurrency, which, has insane growth potential, but can also be an absolute roller coaster. And then there's entrepreneurship, starting your own business. It is the ultimate hands-on approach. And even within that world, there are two pretty different paths to take. You can start a business totally from scratch, or you can buy into a franchise. And if you're thinking about it, just look at this chart. The difference in risk is, well, it's massive. A franchise gives you a proven playbook, which is why the failure rate is so much lower than just going it alone.
Phew. Okay, we have covered a ton of ground, from safe savings accounts all the way to starting a business. So what's the right path for you? The goal here isn't to find the one best way, it's to build a personal blueprint that actually fits your life.
I love this quote because it just nails the whole point. There isn't some magic formula that works for everybody. The right answer is deeply personal. It depends on your goals, how much time you have, and frankly, how much you want to deal with it.
So, how do you figure out your own blueprint? It starts by asking yourself 5 simple questions. First, how much time do you have and how much risk can you stomach? Then, get practical. How much do you care about paying fees and how involved, really, do you want to be in managing all this? Your answers are your guide.
And that leads to maybe the most important takeaway of all. Look, the perfect investment plan that you give up on after 6 months, it's worthless. But a pretty good plan that you can actually stick with year after year for decades, that's what builds real wealth. Consistency is the name of the game.
We've laid out the map for you, from the safe foundation of a savings account all the way to the frontier of entrepreneurship. Your journey starts today with a single step. So, what's your first step going to be?